Multigreen, building attainable, sustainable, and tech-enabled multifamily real estate through impact investing.
Welcome to the Multigreen podcast. I'm your host, Randy Norton, and today we'll be speaking with the Executive and Research Director of the Stanford Global Project Center and one of the most influential academics in the institutional investing world, Ashby Monk. His expertise and insights have been featured in The Economist, New York Times, Wall Street Journal, Financial Times, Institutional Investor, Reuters, Forbes, and now on the Multigreen podcast. Enjoy our conversation. Ashby, let's dive right in. I'm going to quote you when I say, few folks get the privilege of saving the future as part of their day jobs. Doctors and firefighters save lives, and if lucky, a pro athlete may save the championship game. And politicians are mostly just trying to save face. But with zero exaggeration, the people employed by institutional investment organizations go to work every day to chip away at the problem of saving the world as we know it. That's a really bold statement. And I loved that.
I know. Yeah, thank you for reminding me of that. I think first and foremost, I want these people that work at pension funds and sovereign funds and endowments to see their role as just critical. And that's the way I see it, first off. So I want them to realize it. That's why I used to write this column called Avenue of Giants. I wanted everybody to realize that these were the giants of capitalism. These funds, if you kind of add them all up, the beneficial investment organizations, as we've come to call them lately, have about $100 trillion. So if we're going to prevent climate change, or we're going to figure out a way to solve a whole series of problems that kind of ails society today, we need their capital. And so you really need to understand how they make decisions and the constraints and challenges they face. But yeah, I think I wouldn't change that. I still think that those are the folks that are going to be chipping away at the biggest problems facing us all.
It's so profound. And the reason why I love finance, the power of finance, is just that. And today we're going to talk about how to save the world and how to be a superhero. Are you ready?
Let's do it. I'm keen.
So the very first time I met you was at a Stanford Investor Forum, I believe in 2017. And I don't know if you know this, but that was the inspiration for creating this Multigreen platform. Can you tell our listeners more about these annual events that you host?
Yeah, sure. I mean, I miss face-to-face events. It's been a long time since we actually got to do that because we've been living in this COVID thing for 9 months. But in a bygone time, we used to come together as a community and think about innovation in the context of investment. And we would do that across a range of investor categories. But one of those categories was family offices. And so the event that you came to, we host this annual event designed around family office investing. And the reason we did it from a research perspective is that family offices they're long-term investors. So they're often taking this intergenerational mindset. And really, it's those generations that often drive a lot of the investment policies in these funds. But they also have flexibilities that a pension fund or an endowment may not have because they're family owned. They're family controlled. And often the people leading these organizations are family members. So they can experiment in ways that pension funds and sovereign funds don't feel as comfortable doing. And so that's why we hosted. We would want to, share our research with this community, and then also just be able to be a fly on the wall, watching this community talk to each other about the things that they are working through or hold dear or any of those issues, because it would inform the rest of our work with the other investor types.
That's a great response. And I think you wrote about this short-termism concept really in your first book, Reframing Finance, New Models of Long-Term Investment Management. Can you summarize what that is and this new collaboration model of long-term investing?
Yeah, sure. So short-termism, we definitely talked a lot about it in Reframing Finance, because that's ultimately what we're trying to break out of. We want to prevent these long horizon investors from taking this month to month or quarter to quarter view, because it limits their ability to consider kind of really big risks to their portfolios that may be sitting 10, 15, 20 years out in the future. Climate change is the obvious one, but there are others. And so those organizations are inherently long-term. They have liabilities that in some cases extend out 100 years. Like there's some liability inside CalPERS or CalSTRS today that is probably beyond 100 years. There's some teacher that's accruing a pension right now. They're going to get remarried when they turn 75 to some young person, and that young person is going to have a spousal benefit, into 2120. And so these organizations have as part of their DNA a long horizon. But in our research, and frankly, in our experience, we saw these organizations giving up that horizon in the pursuit of short-term outperformance, investment outperformance. And so in the Reframing Finance book, we were like, look, you long-term investors, you have this advantage. You can look at investment opportunities. You can take the illiquidity associated with multi-decade investments. Why aren't you doing it? And the response that often came back was none of the service providers that we're working with do this, because if you're in the private sector and you're trying to, generate a profit for your shareholders or for yourself, you can't wait 40 years for the returns to come back. And so the collaborative model was all about these long-term investors working with each other to design new vehicles and structures to deploy capital over that longer horizon for the explicit purpose of generating higher risk-adjusted returns over the long term. And so, I don't know if that answers the question, but it was really about empowering these long-term investors to take advantage of their innate characteristics of long-termism and use it as a way to generate performance.
Oh, it's a great summary. And there's so much fees and I think you call it tolls and taxes in this industry. And I think there was a few things that you suggested in your book, Reframing Finance. One was this idea of disintermediation and reintermediation, this idea of getting as close to the asset as possible. And oftentimes that was through co-investment or collaboration and insourcing, and really looking at an after-tax net of fees, bottom line type investment returns. Can you explain a little bit further as to all of these fees and how they're miscombobulating our real return model?
That's my new favorite word, miscombobulating. I think I'm going to use that one. I have to tell you that the fee and cost issue, I'm kind of like, painted with the fee and cost brush. Everybody thinks of me as the person going after the asset managers. And maybe that's fair, but I want to put out there that the purpose of being militant about fees and costs is less about, making sure managers aren't disproportionately taking the share of profit they generate. It's that in part, but it's more about just ensuring we have an alignment of interest between the asset owner investor and the asset manager. And I can't think of a better way of unraveling incentives and alignment than to get to the heart of the fees and costs that are being charged for managing the money. Unfortunately, especially in the US, our asset owner investors are still not good at tracking how much we're paying managers. Just 3 weeks ago, CEM Benchmarking, it's partly owned by McKinsey and it's up there in Toronto, reported that pension funds in the US are only tracking half of the fees and costs they're paying to Wall Street. Asset managers, whatever. Wall Street is the kind of name that we can call all that. But we're just not tracking it. And so how do we know what the incentives are that we're setting for this capitalist system if the asset owners, the base of capitalism, the $100 trillion, doesn't know or doesn't report on the incentive structures that the rest of the capitalist system is taking forward, from the managers to the bankers, finally to the CFOs and the companies themselves? How can we control and manage it? We're not measuring it. And so as we measure it, our logic was the asset owners will start to manage it better. And that's where you get this push to re-intermediate or disintermediate We acknowledged right from the very beginning that probably only 1% to 4% of the asset owners could ever meaningfully disintermediate the asset managers. They just didn't have the governance, they didn't have the internal resources, they didn't have the stomach to pay the compensation needed. But that didn't mean that we couldn't catalyze a re-intermediation through a kind of militant understanding of the incentives and the fees and costs to basically restructure the model that we partner with the managers on, whether that means just different fee structures or different corporate structures. We wanted the world to go out there and experiment with those things. And we've seen a bunch of interesting things, permanent capital structures, and all kinds of different things emerge as we've gotten the fee and cost issue right.
Well, you're making it almost a public service announcement, and we're hearing it loud and clear.
Yeah.
You mentioned also that all of our existential threats to humankind, such as health and our happiness, could also be mitigated by the availability and responsible deployment of this long-term funding. Can you explain further?
Yeah, it'll be an interesting 4 years ahead of us. I mean, we're sitting here recording this just as we're going through a presidential transition, but it's also a transition where it looks like, I mean, we'll see, but it looks like the Senate will remain Republican and that executive will be a Democrat. And so where are we going to get all the capital? We're not going to be able to just pass new legislation. Where are we going to get the capital, in the next 4 years to prevent the worst of climate change or invest in our nation's infrastructure, which continues to get Fs? Well, there are all these pressing questions. And inevitably, the answer that will come back will be, hey, what about all these pension funds? What about all these endowments? There's 30 trillion in the US sitting in these long-term investor organizations. Oh, by the way, these long-term investor organizations don't pay tax because we've deemed them as charitable and beneficial to society. Well, that's an interesting lever where we could almost conceive that tax status or the ability to accumulate capital quickly could be a leverage point to kind of push them in new directions. That risk capital is going to be called on not only to pay pensions, but to invest in things that are societally important: clean energy infrastructure, transitioning the economy to low carbon. I expect these asset owner investors are going to play a big part in that. But in order to do that, we need innovation. And this is the part that is the hardest for this community. We designed these funds to be conservative and slow moving. Creativity was seen as a bug, not a feature of a public pension plan. It was to be crushed. I'm sure you're experiencing this, or about this. Many don't invest in first-time funds. They don't even invest in second-time funds. They invest in third-time funds. So once all the innovation has been kind of squeezed out of something, that's when the pension funds are allowed to invest. But we can't do that if we're going to unlock this capital for innovative things. We need to catalyze new innovation in this conservative community of investors. And so that's what will be interesting in the Biden administration. Will they push innovation in this community as a means of unlocking capital to solve all these problems we were talking about?
Do you see attainable housing as an infrastructure asset class? By definition, if you're looking at long-term, stable, inflation-linked cash flows, how is housing being left behind and not being a part of that conversation?
Yeah. You could think of it as infrastructure. Like you say, it's cash flowing and it's often highly regulated, right? So we think of infrastructure assets as almost monopolistic assets, in that like the government has provided some exclusive license to manage an asset and then extract a share of the revenue for managing it and making sure it's sort of doing what it's meant to do. There's a lot of people who see student housing or affordable housing or housing for the elderly as kind of a clear infrastructure asset with a lot of those characteristics. I think the challenge in the infrastructure space is always around how do we build more of it? So the greenfield infrastructure. rather than how do we invest in the stuff that already exists. There's a long line for investing in stuff that already exists. There's not long enough of a line for the greenfield.
That's a really great insight. Well, I want to segue back to your comments on innovation because you wrote a second book. The second book was The Technologized Investor, Innovation Through Reorientation. It was actually a homage to one of the greatest books on investing, The Intelligent Investor by Benjamin Graham, the father of value investing. Benjamin is certainly one of my superheroes. My son Edison considers his protege, Warren Buffett, a superhero because he can do stuff with his mind. You say in your book that superheroes transform from being mere mortals into superhumans by technologizing. Who is your favorite superhero and why?
Well, gosh, growing up, I would have said Batman. Batman was definitely the top of the list because he was a mere mortal. Now, fine, you can say, well, he was trained in all these different things, but through his brain, he was managed to build all these different tools and techniques that allowed him to achieve huge, important things. So that was attainable for me. That was something, Superman, I'm never going to be born on an alien planet and get launched here. But a Batman character is something we can all hope to be, like an Iron Man as well. I would say that those are the ones that kind of really got me excited when I was growing up.
And you wrote extensively about it. That is the theme here in The Technologized Investor. But you also mix in a little bit of capitalism and economic theory. You said, I think, technologized investors can save capitalism. And you also say that organizations treat data like communists. Can you explain?
Well, the first part of that is just this recognition, like we've been talking about for the last 15 minutes here, that these asset owners, they have this DNA that could save us all. Like it's there. They have $100 trillion in capital. They have a liability profile that makes them almost perfectly suited to invest in infrastructure, clean energy, even things like drug discovery. Like all these long-term risky bets are perfectly suited to these intergenerational investors. But so how do we free that power? Well, we need these organizations to live up to that promise by changing. Are we going to change them through governance? I've tried for 20 years, and to a large extent, I can tell you it's very hard. We're not going to change CalPERS board. We're probably not going to change it for 30, 40 years, but we're definitely not going to change it in the time scan that we need for climate change. And so we turn to technology. Technology is a key driver of new efficiencies, of insight. If you think about what we do in investing, we're constantly trying to convert data into information and then convert information into knowledge and then use that knowledge in some decision, what we call intelligence. Unfortunately, that conversion of data to intelligence, what we call this hierarchy of insight, as you move from data to information to knowledge to intelligence, is something that we haven't routinized. We don't have the kind of understanding exactly of how that happens. It happens through technology kind of on its own, which is partly why we've pushed these organizations to embrace technology. But often we don't even realize that this data we have is valuable. We don't treat it as an economic resource that can drive comparative advantages. It's just there. And that's the kind of communist notion, is that like, oh, no, isn't this data like something that we all have a right to and that we can all benefit from? Or how do we cultivate its value is not a question that we hear being asked. And so that's what we've pushed for. I know that I'm synthesizing a book down into 12 seconds, but we really want you to use technology to create value from data and convert it into information. So just to tell you what the hierarchy of insight is, data is like any reading off a sensor. Information is when you put data in context. So when you're surprised by any piece of data, it's now information because you had some context. Some piece of data comes in and you're like, I wasn't expecting that. Well, that means that you had some expectation, and that means it's actually information. When you have enough information to start making generalizable assumptions about the future or about your past performance, that's knowledge. Now you can start to like create an ontology, a worldview with knowledge. But then how do we get that knowledge into a format to make decisions from it? Put it in an investment memo, trigger a trade. That's when knowledge becomes intelligence. And so every investor is trying to take that data that's coming out of their Bloomberg terminal or off a stock exchange or from some private company and get it into a format where it's intelligence and it can be used. But to do that, you really have to be proactive.
That's great. And you speak about operational alpha from these data and organizations being about process. You really drove home on process. But you said that world-class data is now the ultimate superpower. Data is the new oil, the new soil, the new nuclear power, one of the largest assets on balance sheets today. I can't believe that.
I know, it's wild that we're at that point, but I mean, it's pretty easy to see when you see why is Facebook what it is or Google what it is. I mean, they're just managing the world's data and really managing that hierarchy of insight very well. They're taking data and they're delivering you information and knowledge, and then it's up to you to use it. We're obviously not the first one to say that data is oil. A lot of different authors have read about it, but it doesn't feel, the reason we said it again in this book was it doesn't feel like the investment community, aside from some like real leaders, have owned that yet. Like internalize the fact that like it's data and information that you get out of a network or you get out of a relationship or you get out of a piece of technology. Ultimately, in the business of investing, we are constantly in search of data, information, and knowledge so that we can make smarter capital allocation decisions. And so anybody that doesn't fully appreciate the value of data and where they get it and how they manage it is going to struggle, especially as all of this becomes quantified and more easily tracked.
Scientia potential est. Thomas Hobbes. What does that mean?
I forget. What you tell me. I thought they were asking you.
Knowledge is power, and arguably
right.
more desirable than data. I think that's absolutely right.
Well, so that's part of this hierarchy, right? It's knowledge is power is the sense that once you have converted all your data and information into knowledge, you're in a position to choose what you make decisions on. And that's when it becomes intelligence.
I want to take a key takeaway from you. You say that you have a formula for saving the world. And it was this, and I quote, "Just keep swimming, check the flight manual, talk to people, ideate, test, and repeat. Simple, doable, replicable. That's pretty much the formula for saving the world," close quote. Does your thesis change?
No. If anything, the iteration and ideation that comes out of collaboration, that's the first book. And it flows into the second book, which is like, then how do we innovate and how do we create, new strategies and investment processes to go after the big grand challenges? That is precisely what we're pushing all of these large asset owners to do. And at Stanford, we host this meeting, GTOS, Global Investment Technology Operations Symposium, which brings together the world's biggest investors to do exactly what that quote you just read is about. They come together, they collaborate, they ideate, and they think about how technology will transform their investing. And it's 30 of the world's biggest asset owner investors, and they're trying to change how they do it. And so it's a really exciting time, actually, to be working with them and watching how they're thinking about their future business model.
That's so thrilling.
They're fundamentally rethinking their model. Yeah.
We'll have two final questions for you, Ashby. In the spirit of Multigreen, what are a few of your favorite green things? That can be anything green.
Well, that's actually part of what's occurred in this COVID. I mean, I think we're all rediscovering the world that is kind of at arm's length because we've been stuck at home. And so for me, I've been gardening like a ridiculous amount. I think we've planted, we live up in the hills, so not right in town. So we have more space than maybe a typical academic at Stanford would have. And we've planted 30 trees and probably another 40 or 50 like bushes and plants around our little piece of hillside. And I've just gotten a huge amount of pleasure from that. So I'd say that is my favorite piece of green right now. I have like a little citrus grove, and I'm growing a fig tree, and it's wild. I've just learned so much too about the process of how you grow stuff.
Well, thank you for sharing that. It is now 2020, and we're at the end of our first year of operations. We publicly launched from Davos, Switzerland at the World Economic Forum, and we announced that Multigreen would improve the state of the world by constructing 40,000 attainable, sustainable, and tech-enabled multifamily homes. If you had one wish for Multigreen, Ashby, what would it be?
Well, that you become a role model for how to do it around the world. So it's well and good to suggest that you succeed. I hope you do. But we need so much sustainability and housing, and we need to convert so much that, like you're doing, go out and tell the story, and don't be afraid of fast followers or competitors coming in behind you. Get as many people trying to chase your success as possible. That's the work that I'm all about doing, which is democratizing strategies and access to move as much capital as you possibly can. So that would be the success. Have so much success that everybody in the world wants to copy you, and we get this amazing ecosystem of sustainable housing.
And I hope they do. I think we estimate that about 99 more companies need to be created like Multigreen just to put a dent in the housing crisis of at least 4 million more units needing to be constructed here in the United States. Ashby, you are one of my superheroes. I hope that Multigreen can be a superhero, and that together we can go save the world.
Oh, thank you. Well, you're doing it. You know, it's everybody needs to take steps like you're taking. So I'm really encouraged by your launch, and hopefully the success follows quickly and we can get a bunch of other people chasing you along the way.
Thank you so much for your time today, Ashby.
All right. Take care.
You too. Bye-bye.
Thank you for listening. Join us as we build 40,000 attainable, sustainable, and tech-enabled multifamily homes by 2030. And if you like the content you're hearing, hit the subscribe button. Follow us at Think Multigreen and sign up to learn more at www.multi.green.